Everyone, Michael here from Simply Wall Street. So in this video, I just want to show you a quick overview of how I research stocks using the company report and how the company report actually forms like a large part of my whole investment process. So I'll walk you through the report as I read it when I research a stock. In this example, we're going to have a look at Amazon. So first things first, I start at the top and I can see here, the first thing I check out is the snowflake. And from looking at the snowflake, I can see that the company, Amazon, does really well in health, past and future. More specifically, it seems to pass 5 of the 6 checks for each one of these metrics that are checked in these sort of areas. So when I get to those parts of the report, I'll look into more details about what checks it does pass, but already it seems to do well in those 3 areas. As for valuation, it only passes 2 of the 6 metrics, so I'll want to look into which ones it does well in and which one it doesn't, and I can see here that it doesn't pass any of the dividend checks. And now I know already that Amazon doesn't pay a dividend, so that makes sense as to why it passes none. So before I even start looking at the company, I know that from looking at this, it has a solid track record with high growth potential, so good to know. And then the next thing I look at is the risks and rewards. So I can see here that one of the rewards labeled is that the company is reportedly trading at about 38% below Simply Wall Street's estimate of fair value. So that's something that's really interesting, quite a big discount. So I want to have a look at the valuation later on. I can see earnings are forecast to grow about 28% per year for the next couple of years. So that supports the high future growth expectations. And one of the other rewards is that earnings have grown 123% over the past year. So it's had an incredible past 12 months, and that's also backed up by the well it's done well in its past performance. And then as for the risks, it just alerts me to the fact that the company has a high level of non-cash earnings and has a high level of debt. So I'll be able to look into those more detail in the report, and I'll basically want to see why that is the case and if it's anything I should be concerned about and if it's something I should look into further in my research. So good to know about that straight at the start. Next, I just want to have a quick look at Amazon's competitors, and I can see basically an overview from their snowflakes. So I know what Amazon's snowflake is like, and now just at a high level, I can compare it to its competitors. And what I'll do typically is once I finish the company report for the company I'm interested in, I'll then look at its competitors. But just at a high level here, I can see like for the likes of Alibaba and JD, they both perform better in the value section. And I know that's because those particular stocks have had quite a beating recently. They perform better in health, probably because maybe they take on no debt. I'll have to check that out. But they both don't seem to do as well in the future and past performance sections. So Amazon outperforms them in those areas. But that's just a high-level overview of what I can get from its competitors, and I'll look into those reports as part of my process later on. Next, what I look at is the price history and performance. Now, just to be clear, I don't use share price as like share price movement as like an indication of whether to buy or sell. But what this section does for me is it shows me the history of share price movement in many different periods from 1 month to like max. And what I do here is I typically want to look for any noticeable changes in share price and if there's any particular events that happened around that share price movement. So for example, the company's been pretty flat over the last year, to be honest. But like this dip here, if I want to have I would have a deeper look into this and try and look at some of the actual company announcements that happened around here, whether it was like announcing earnings and I think from memory, the company actually had a report announced earnings around July or so and just basically gave lower guidance for growth. So then expectations from the market were, softer from investors. So I think that's, from what I recall, that's why the stock pulled back. But if I didn't know that, I would basically read through these announcements and developments, and that would give me a more qualitative understanding of what projects the business is implementing and how the share price reacts accordingly. So for the last year, there hasn't been any major positive or negative catalysts that have sent the stock price soaring or crashing. But yeah, if I look at longer time periods, I can also get an idea. So I would also want to check out some developments that have happened back here. And I can filter through whichever ones I want to view. So if I want to remove the strategy ones, I can view the other ones. But I just want to get a look at the particular developments that have happened, because some of them are multi-year projects. They might announce that they're doing, building a new data center or a fulfillment center. They might have announced that back here, and then it might actually finish completion a couple of years later and actually be contributing to the bottom line. So that's something I'll look into just to get a better idea of the underlying business. And so this chart is full of updates. And once I've finished reading through the company report, I'll basically go back and try and piece together a story, and it can help me build a narrative around the stock. And also on that note, the next thing I look at is the recent news and updates. So this bit here is basically all the news, a lot of the news sources and updates from both our internal news team and partnerships that we have with the likes of Seeking Alpha. Now, some of these are articles that are written by authors who contribute to Seeking Alpha, and so just keep in mind they're people's opinions. But what I do here is I try and read through them because there's people who are very bullish on the stock and very bearish and everything in between. So to get a better idea of the underlying business, I will, once I finish with this report, read through these articles and get an understanding of why people are bullish or why people are bearish, because it wouldn't make sense if I just read all the bullish ones and then myself became super bullish on a stock and I was like, nothing can go wrong. Instead, I want to read why people have reasons to be negative. And then with all that context and all that idea of the potential of the stock, I can then make a more informed decision. I can see, like, what do I think is more likely from all the possible outcomes there are. I can then make a decision myself and think, oh, no, I don't think that's as big of a risk that this person's concerned about. I don't think that's very likely to play out. Or someone's super bullish on an example of a project, and I think, oh, yeah, it's a good project, but I don't believe its prospects are as high as you expect them to be, that kind of thing. So by reading through all these articles and news updates that come out, I can get a better idea of the underlying business. So these two particular parts really help with understanding the underlying business. They're more qualitative data, whereas a lot of the report is quantitative, but you can still learn a lot of insights from it. So that's what I'll do when I'm diving deeper into the stock, if after the company report, I'm like satisfied that I want to continue researching the stock. The next part I look at is like shareholder returns, and this basically just compares it to its industry and the market that it's in. So as we mentioned, I can see that Amazon's been like pretty flat for the last year, though it's outperformed the online retail industry in the US, which has actually declined like 11%. But the US market as a whole has done really well over the past year. So basically expectations for Amazon have been pretty muted over the last year, probably because it did so well over the past year and it's over the year before that, and it's now like consolidating. But yeah, the US market has just been on a tear in the past 12 months. So if I didn't know the stock too well, which I already do know Amazon pretty well because it's a well-known name and I'm familiar with all the services they offer, but if I wasn't, on like a different company I'm looking at, I would read through this to see ultimately what products and services they offer, and like what kind of business they're in. So this about the company section here just tells me a bit more about it if I want to know more about the underlying business. Next, I look at the fundamental summary, and this is just a high level, but it's very informative. So I can see the company has a market cap of 1.7 trillion, revenue of 443 billion, and ultimately earnings of 29 billion. So those metrics there give it a PE ratio of 58. Now, on the surface, when I see 58, I'm like, okay, that's pretty high. But as we saw from earlier, that the company is expected to have earnings growth of like 28% per year for the next couple of years, that's very impressive. So that high earnings growth or high future expectations of earnings growth backs up why there's currently a high PE, because ultimately PE ratio is like reflective of what investors think the company's potential is. So a lower PE means investors ultimately expect like low growth of earnings from the company's future. Whereas a high PE is investors have high expectations, like, yep, it's going to do well, it's going to grow its earnings really highly. So what I want to keep an eye out for is like if it was trading at a PE of 58, but it didn't have expectations of high earnings growth, like 5% earnings growth, that would be like a disparity that I'd be really concerned about. I'd be like, okay, everyone's got high expectations, like they're paying a high multiple for the stock, but it's not backed up by like expected earnings growth. That would be a red flag. So in this case, it kind of adds up. 58 makes sense because it has high earnings growth. And then price to sales is another ratio that's useful as like a metric to compare companies. In this case, it's not too meaningful to me because Amazon is profitable. I would mostly use that if I was looking at like unprofitable companies that didn't have any earnings, so I can compare them on a price to sales basis against each other, but it's not too meaningful to me here. Now, this is also a part, the next part that I look at is very meaningful and quite insightful. It tells me about how the business operates and ultimately how money gets to the bottom line. Being earnings. So to generate the $443 billion worth of revenue, which is selling its goods, like it's the products on its online retail e-commerce site and its Amazon Web Services and all the other products and services it offers, it costs the company $262 billion to deliver that revenue or to offer that revenue. And that cost there is things like the cost of goods sold, like actually if they're buying the underlying product and then selling it, like that's included there. The fulfillment costs involved in like delivering the service, basically any cost that they need to make to deliver that revenue is included here. And so I can see it costs them 262 billion to generate 443 billion. So while 443 is a lot of money, it also costs them a lot of money to generate that. So that gives the company gross margins of about 40%, and that's pretty good. That's very healthy. Like, the company has plenty of room to work with then, because it can then go down to the next section. So this delivers it with a gross profit of 180 billion, and that's just revenue minus the cost of revenue. And then with this gross profit, this next section, expenses, basically is like what the company spends money on to run its day-to-day business. So that's things like sales and marketing, like advertising. General and admin is what it's called. It's basically like running the business. Could be like employee expenses or offices or rent and stuff like that. And there's other things like research and development. So they'll be, this 150 billion is a combination of all those costs, and like the research and development is stuff like that they're investing in now to like build new products and improve services and basically like optimize and have products for the future. So they're spending quite a lot of their money. So they have 180 billion, they're spending 150 billion of that, and that leaves them with 29 billion left over. So that leaves them with a net profit margin of 6.64%. Now that's actually pretty slim. So it's very slim, but I know that from their practices, like they've got high expectations for future growth. It makes sense for them to have slim margins because they want to keep reinvesting in themselves, because they have so many opportunities as a business. So I'm basically shown here that they're investing a lot of the money they make and they have a little bit left over, but they ultimately have like slim profit margins because they're not looking to be profitable right now. They have such a big opportunity in front of them. From the little that I've done on like researching the e-commerce space and the cloud computing space, there's so much opportunity in front of them that they're reinvesting heavily. Like, it makes sense that they're not just hoarding their cash and like spending the minimum amount possible. They're reinvesting heavily. So that's what I can take away here. And the debt to equity ratio, 45%. That's pretty high, but I'll get down to the financial health section later and look a bit more into that as to like if it's unreasonable for a company like Amazon. So the next bit I look at is valuation. And valuation ultimately is like one of the most important things with investing. It's like a great business can become a poor investment if I pay too much. So I want to basically make sure that I'm paying a fair price for a great business. And from Simply Wall Street's estimate of fair value here, I can see that they think it's trading at roughly 38% below their estimate of fair value. That's quite a big discount, especially for like an established company like Amazon. So that's a good sign. But if I want to get more detail, which often I do, I'll look at the view data here, and basically it shows me the inputs that the company uses on its Simply Wall Street uses in its model. So like the discount rate, what they expect the perpetual growth rate to be, and it shows me where all the data is from. And basically I'll look at this, and as I do my research further and further, I'll basically be able to then decide if I think those inputs are fair or not. And so while it's great to know now, I know that this valuation section is not a buy or sell recommendation. It's simply just providing me like an estimate, like it's a model. It's providing me like an estimate of fair value, and it shows me the inputs that it put in. And so when I do the dig deeper on the company and look at like its underlying business and projects they're working on, I can then make an assumption with my knowledge of the company of whether I think these growth rates are fair or not. So just looking at it here, like I haven't got much context of the company, so it's good to know that this is how it's been done. But then I'll come back here once I've done much more research on it, and then I can make my own assumptions. So I can create a model elsewhere, like on an Excel spreadsheet, change the inputs, like a higher discount rate, lower discount rate, whatever I think is necessary, and then get my own estimation of fair value. But yeah, so this isn't telling me whether to buy or sell. It's just saying, if you use this model with these inputs, here's an estimate of fair value, and here's how we got them. So they base it off analyst estimates, expectations, and that's a future cash flows. And that's how the model is built. So I'll come back to that part later in my research process. Won't do it in this video, but that would be something I come back to. The next thing I look at is the price to earnings ratio. So this gives me a bit of context about like how it's valued right now compared to the market and industry. So I can see here that it's at a much higher multiple compared to the market and industry, like 31% for the industry, online retail industry, and 18% for the market. So it's trading at a much higher multiple. But again, as I saw earlier, it's trading at a higher multiple because it's got really high expectations of earnings growth. So when I get to the future section, I want to see what the expectations are for the market and earnings and their underlying earnings. And if it compares how it compares to Amazon's expectations. So this is good just as a snapshot, but I'll get more details on that soon. Next is price to earnings growth ratio. That doesn't really mean a lot here, so I don't look into that too much. Basically, it's just trying to represent how much you're paying now for the expected growth, and generally anything below 1 is considered good. And price to book ratio, this doesn't really apply to Amazon. It's not a company like this. Tooltip here tells me that industrials and financials is what this ratio is typically used for, because it tells you like it's a company that it's used for companies that generate a lot of their income from their asset base, and Amazon just isn't one of those. So it's not too applicable here. And then the next thing I look at is the future growth. So here is that expectations we saw of like 28% earnings growth for the next couple of years. And that's based on the estimates from like 45 analysts. So I can see here the company does well in a lot of checks, and I can get more color on that here. So Amazon's been growing the top line very quickly. And as we saw before, it's got very slim net profit margins, but they've been growing as well. So given it's starting from such a low base here of like 8.9 billion or so, 6.2 billion, the fact that it's now 29 billion is quite a high rate of earnings growth, and it's expected to continue in the future. So that backs up why it's trading at such a high multiple. As for the free cash flow and cash flow from operations, here is where I can get some insight into that risk that was pointed out to me earlier in the report. So it said if the company has a high level of non-cash earnings, I can see that for the most part that actually isn't the case. Like free cash flow does line up with earnings, as in the company has a high cash conversion rate, which is good. But for the last 12 months, free cash flow has dipped quite a bit below earnings. So that risk was pointed out to me. Now, what I'll do in my investment process is basically look into that. Why did that happen? So I can see, though, analysts actually expect, because this is their forecast, they expect free cash flow to recover and then actually surpass earnings again. So it seems like it's only a temporary issue, but it's still something I'm going to look into. So to look into that, I'll go to the company's annual reports and I'll look at the cash flow statement and I'll see what costs they've incurred that has resulted in that over the last 12 months. So just to get some color on that. But to be honest, it seems like it's just a short-term issue. So nothing too concerning. Next, this is what I was talking about with the comparison to the industry and market. So I can see here that Amazon's actually expected to have earnings growth and revenue growth very similar to the industry, which is kind of interesting considering it's trading at a much higher multiple than the industry. Industry was at like 31 PE times 31 times earnings. So considering it's got roughly in line the same earnings expectations, it might just be the fact that Amazon is like a really well-known company, like one of the biggest in the world, and investors are willing to pay a premium for that kind of quality business. So they're happy to pay a higher multiple because there could be smaller online retailers that just aren't as well known, and they're not willing to pay as high a multiple for them. So that's one takeaway there. And then it makes sense that Amazon's trading at such a high PE compared to the market, because the market doesn't have anywhere near as high expectations for future growth, both in earnings and revenue. So that's the insider takeaway there. And the company's passing all the checks here, which is great for me to see. It just doesn't have hyper growth in terms of its revenue. Like it's below 20% per year. 14.5% is still really good, but yeah, it's just not hyper growth. And the next part I look at here is the earnings per share forecast. Basically, this tells me what analysts expect for the earnings per share, because ultimately earnings per share is like the company's underlying earnings, but based on your slice of the pie. So like how many on a per share basis instead of like a whole company basis. So this is impacted by whether they are expected to like issue new shares, because if they issue new shares, that increases the slices of the pie and like decreases yours if you don't buy anymore. So here, this accounts for share dilution, which is important to keep in mind. So I can see here that analysts actually expect earnings to dip a little bit over the next couple of months, end of 2021 and onwards. But they all generally, the consensus is they expect earnings to recover, and all of them virtually expect earnings per share to grow, at least from where they are today. However, I can see that there's like quite a wide range of expectations. Like some analysts expect $127 per share and some expect $67. And the consensus therefore is like $91. So there's a wide range of estimates. Some analysts expect really high earnings growth and some expect like moderate growth, considering 67 compared to the $58 today over a few years. That isn't the highest rate of earnings growth, but if like the 127 was to happen, that's quite high. So what I want to do is, like, as I get more color on the company and more context and more of a understanding of it, I'll then basically be able to form my own opinion on which expectations I think are most likely. I don't have to take them at a face value. I can then look at the company myself and then make my own opinion on like yes, I think those are likely, or no, I don't think they're likely. So that's a good context there. Future return on equity is what I look at next. Basically, this tells me how profitably the company is allocating shareholders' equity, and I can see here that it's 21. It's expected to be 21% in 3 years' time. So they're expected to still profitably allocate shareholders' money in the future. So that's great to see. They're choosing like profitable projects to invest in, and here it would be like Amazon Web Services and their fulfillment centers and stuff like that. So they're allocating the money well. They're not allocating into like unprofitable initiatives. So good to see, and that's also better than the industry, which is also a tick. Next, I just look at past performance. Basically, what I can take away from past performance is like if the company's reliable or not. So this basically helps with setting expectations for like future growth. So if a company's really unpredictable with its revenue and earnings and they're going up and down like crazy, it's really hard then to try and forecast or like make any sort of solid predictions about what's going on in the future. However, if the company has like slowly but surely like increased its revenue and earnings at a reliable and sort of consistent pace, that's very eye-opening because it tells me like it's a reliable business, it's got a proven track record of like a proven business model, and it therefore makes predicting the future a bit easier. So obviously the future's very unpredictable, but that just helps provide some context when I'm trying to make some estimations of the future. So Amazon's earnings have grown incredibly quickly over the last 5 years. As we saw, it's passing like 5 of the 6 checks that Simply Wall Street looks at. And when I look at it here, it's the same stories from the future growth chart. But what I look at here more importantly is I want to pop on operating expenses. So operating expenses is like the expenses that the company needs to make to run its business, to operate. And the key takeaway I have here actually is I can see that revenue is growing very quickly, but operating expenses aren't growing as quickly. And that's really good because basically for every additional dollar of revenue that the company makes, it's not incurring as much of an operating expense, so more money goes down to the bottom line because it's basically reached a stage where it's got a lot of its core operations set up, like staff and fulfillment centers and all that, and so its operating expenses. It's at a stage where it's got scale. So for every incremental dollar of revenue, it doesn't need to spend that much on its underlying business, and so it's reached a state of scale where it's like every additional dollar can flow through to the bottom line. And we can see here, right? So that's resulted in the increasing profit margins. So back here in 2016, it was like 1.6, 1.7 in terms of net profit margins because of how revenue and operating expenses worked out. But as revenue grew really quickly and operating expenses didn't grow as quickly, it's now at a stage where its net profit margins are like 6.6%. So things have really improved in that sense, and if revenue does keep improving as it does and operating expenses don't grow as quickly as revenue, the net profit margins then would keep increasing, and ultimately that's a great sign for shareholders. So profitable business that's like reached scale and every additional sale is very beneficial to the bottom line. So that's a great sign to see, and that also helps with the forecasting, like I mentioned. So the thing that we touched on before, but it says non-cash earnings here, high level of non-cash earnings, that's what I saw also in the future graph. So I can see here that there's been a dip, and as I mentioned, I'm going to look into the cash flow statement and try and find out why that was. But I don't think that's too concerning because analysts expect it to recover, so that's all good. And net profit margins have been growing, which is great. Next, I have the past earnings growth analysis. This is very similar to the future growth section where it compares it to the market and industry, but it's basically tells me more of the same. So Amazon has done incredibly well. Like it's been a market leader in terms of its performance. It's outpaced the online retail industry, and in both the past year and the past 5 years in terms of earning growth, like 32% is nothing to turn your nose up at in terms of annual earnings growth. But Amazon has done even better than that. It's just like performed incredibly well, and it's top tier sort of performance. And then the last year, like as we know, there was COVID and everything, so it's just performed, even though 62% is huge, it's performed even better with 123%. So I wouldn't expect that to continue or like to repeat year after year because like there was kind of like a one-off event, but it just shows you that like it had scale and operations set up where it could maximize like the macro event that happened. And 39% is certainly nothing to turn your nose up at either, but it just shows you how strong Amazon was set up for that. So passes all these boxes, which is great. So that shows me it's really like a strong leader in that sense. Current return on equity is just how well they currently allocate shareholders' equity, as I mentioned before, and it's about 25%. So that is high. It's great to see that they're allocating money, shareholders' equity, to profitable initiatives right now. And like I said, Amazon Web Services, fulfillment centers, stuff like that, they're using the money well. Return on assets, I can see that it's about 8.5%. That's pretty good, and it's in line with the industry, so pretty fair. And then the return on capital employed basically tells me how well they're allocated capital in general. And last year was 12.2%, and 3 years ago was 8.9%. So they're improving how well they allocate capital in general, which includes any sort of money they're putting to work, not just shareholders' equity. And the next thing I want to look at is the financial health. So here we can see the financial position. Basically, like, is the company, this is what the takeaway I want to learn here is the company leveraged? Like, and if so, how leveraged? Because like, is it just taking on debt because like it can't fund itself? Or is it like self-funding where it's like, yeah, we're generating plenty of cash, we really don't need to take on debt to pursue new initiatives? And in this case, things look good. Like I said, it passes 5 of the 6 metrics that Simply Wall Street checks. And what I can see here already, what I want to see is if short-term assets cover short-term liabilities and long-term liabilities. And I can see here, short-term assets is things like cash and cash equivalents, anything that can be like liquidated quickly and turned into cash to pay your debts. And it covers both. So it covers short-term liabilities and it covers long-term liabilities as well. So if for whatever reason these debts or obligations became due, the company could be like, okay, we can pay them with our short-term assets. So that's like a great sort of cash buffer in a sense of like the company isn't teetering on the edge of bankruptcy. It's like it has cash available to pay what it needs to pay. So that's a really good sign. And the next thing I look at is just the debt to equity history. So I want to see like how they've utilized debt and like if they've basically just been taking on heaps of it or if they've been conservatively doing it, conservatively using it. And so I can see here that they have been conservatively using it. So while equity has been growing really quickly thanks to share price appreciation and retained earnings and everything, they haven't been using debt excessively. They've basically been keeping the debt to equity ratio at a pretty modest pace. Now, anything above 40% is considered high, but considering this cash and cash equivalents balance that I can see is basically constantly outpacing the debt, I can see that while the debt to equity ratio was high at about 45%, I can see here from that light blue line that they've got plenty of cash on hand that surpasses the debt. So they can pay it off in they can pay it off with what they have access to right now. And so the risk that was pointed out was the high debt to equity ratio, but with additional context like that, I can see that it's not too big of an issue. So it's not something to be too concerned about. The next checks it passes are that the debt is well covered by operating cash flow, basically the cash flow that the company generates from its core operating activities. 1 year of cash flow more than covers the debt. So it has $52 billion in debt. I think it generates $59 billion in operating cash flow per year. And so it's 1 year of cash flow could pay off what it owes. And then as for the interest payments on that debt, it's also well covered by EBIT, which is earnings before interest and taxes, basically the earnings before the company has paid any interest and taxes, and that interest payments are covered 23 times by that EBIT. So plenty of room to spare there. We consider anything like above 3 times to be good. This is 23 times. So there's plenty of coverage there. And then just the other thing I look at is more of the same really. I look at like cash and short-term equivalents and if it can cover the debt that the company has. And as we mentioned, it can. $52 billion in debt, $89 billion in cash and equivalents. It can easily pay them should it need to. Now the next part I would look at is dividend. And as we mentioned, Amazon doesn't pay a dividend. So it doesn't pass any of the checks here, but that's not necessarily a bad sign. So a reason why a company might pay a dividend is because it's looked at all of its internal opportunities of where it can allocate money, the money that it earns. So it's like, oh, we can reinvest in ourselves, or we can make acquisitions, or we can hold on to the cash, or we can pay dividends. If it doesn't have any good internal reinvestment opportunities, and it doesn't think there's like any acquisitions and stuff that it needs to do, and it doesn't like want to hold on to the cash, then a company would pay that out to pay that money out to pay a portion of it out to shareholders as a dividend to basically reward them. And that fact that Amazon doesn't pay one here is reinforced by the fact that it thinks it has so many internal reinvestment opportunities in the likes of the cloud computing business and the e-commerce space. It has so many opportunities to reinvest. It's like, you know what? we've got so many opportunities, it would be silly of us to just put this cash out, pay this cash out to you. It would make more sense for us to reinvest it here and compound and like gain market leadership. And really then once it reaches a stage where it's got like no more opportunities, then it might consider paying out a dividend. But for the time being, I'm actually happy with this because it has such a high return on equity. The money that it does invest is investing it quite profitably. So like a 25% return on equity or 21% in the future, that's great. Like I would struggle to find investment opportunities personally. If they gave me the dividend and then I had to reinvest it, I would struggle to know where to put it. So to generate that sort of similar return. So it's great to see that Amazon's like, we can reinvest it and keep compounding growth. And from my perspective, that's great. I'm happy to see that. So a different company with dividends, we'll look at it in a separate video. But for now, this is none of these checks are applicable. But that's just a bit of context about the dividend. The next thing I want to look at is management. So the average tenure, basically, the things I look at for management is alignment. Like are management big shareholders? Like do they have a lot of money invested in the stock, and therefore are they aligned with shareholders? That means they're aligned with shareholders because if the stock does well, or if shareholders do well, they also do well because they are shareholders. So they're aligned to make the best decision possible for shareholders. Also, I look for tenure, like how long they've been at the company or how much experience they have, and then just basically whether or not their compensation is fair considering what they're doing. So like, do they receive heaps of compensation regardless of how well the business does, or do they receive compensation that's aligned with underlying business performance? So that's something I want to check out. First up, I can see here that they have an average tenure of about 6 years, which is great. That's anything above 5 years is considered like a pretty experienced management team. And here's the CEO, Andy Jassy. Now, I know Amazon just had a replacement, so he's only been there for like a quarter of a year. But if I didn't know him, I'd be like, oh, how long? Okay, that's a very short period of time. Has he been there for a while? And I'd read his client profile. And I can see here that he joined Amazon in 1997. So he's been there for like decades. He's got so much experience internally in the business. So that's a tick for me. Like he's not some new guy from outside that doesn't understand the culture and the underlying business. He's been there and worked there for so long that he knows how it all works. So that's great to see. Next thing I check is the CEO compensation. So like that was what I was mentioning. Is he rewarded equally? And I can see here that while he's, so he's paid a salary of about $175,000 a year consistently. Which isn't a lot considering the role and the size of the company. However, total compensation really is quite generous, like $35 million in some years, and it seems to be like an annual sort of basis of like stock options and bonuses. So that's something I want to look into further and see sort of the compensation package and how it works, and I can find that in like the Amazon annual report, so I can look more into that. But the checks here from Simply Wall Street is that his total compensation is quite generous, and it basically is much higher than companies of similar size. But Amazon is like 1.7 trillion, and there's not many companies that are that big. So yeah, it's bound to like not pass that check, considering the next biggest companies would be in a smaller sort of bracket. And his compensation has increased more than 20% in the past year. So yeah, I'll just want to look into company earnings have been growing. So I'll just want to look into like if it's aligned with that and if it makes sense. Next, I look at the leadership team. Basically, what I want to take away here is all the different members of the team and what their positions are. I can read their client profiles, and I will read the client profiles to get more of an idea of who they are and where they've been and what their experience is. And then obviously how long they've been there. As I mentioned, I got a bit of context because he's been in the role not long, but he's been at the company for a very long time. And then I want to see the ownership, like I mentioned, to see how aligned they are. And the takeaway here is for those that do have data, they've all got at least a couple of $1 million invested in the stock. So in that sense, they are pretty aligned with shareholders. They benefit if shareholders benefit. So it's in their best interest to make the right decision for shareholders. And yeah, the tenure's 6 years as well, which is good. Anything above 5 is considered experienced. And then as for the board members, they're all same thing. I want to see like who they are, what their experience is. So I'll go through and I'll read all their profiles, see where they've been and what their experience is. And again here, I can see that, I can see that they've all got at least a few $1 million invested in the stock, especially 172 billion, which is Jeff Bezos. So they're very aligned with shareholders. They've got skin in the game, and their money's on the line. So they're incentivized to make the right decision because they're invested alongside shareholders. What I would want to keep an eye out for, like a red flag, would be if there's all these different managers and board members and they have no money invested in the stock. It's like, then they don't suffer if I suffer. So they haven't got skin in the game. And then, the tenure's strong. Ownership, this section basically tells me if there's been any activity and what the ownership breakdown is. So for the major shareholders, have any of them been buying or selling? And in this case, we can see that for insider trading volume, like managers and large shareholders, there actually hasn't been any shares bought or sold in the last, year. So what I would keep an eye out for is if there's been any buying from many different insiders or large shareholders over the last year, like multiple different insiders. If they've all been buying, that's a pretty strong signal that they're pretty optimistic on the stock and there's a reason to look into that further. Alternatively, on the opposite side, if there's been multiple sales from multiple different insiders, I want to have a look at why that's been the case. Like, have they all just lost confidence in the stock, or is it just like they're exercising their right to sell some shares because they, have personal expenses coming out? So I'll look into the SEC filings of those trades if there is any sort of things to look into and to be concerned about, and I'll try and get an idea as to there's sometimes descriptions as to why they were selling. So I'll just want to look into that and see if there's anything. If there isn't any reasons, good reasons, then it's concerning. But if there are any small trades too, like not a big portion of their holding, then I won't be too concerned. Then as for the ownership breakdown, I look at this just to see who the strongest shareholders are. In this case, institutions own a large portion of it, and it makes sense because it's such a large company. These institutions are massive fund managers, and they buy the likes of the S&P 500 and the other big indexes. So it makes sense that they have a large portion of it because they're managing so much money. General public owns about a third, and then the individual insiders have about 10%, which is mostly Jeff Bezos, and these shareholders own the remaining shares. Importantly, the company hasn't been meaningfully issuing shares recently, so if you're a current shareholder, you haven't been diluted in the past year, which is great to see because, like I mentioned, I don't want to see them increasing how many slices are in the same pie, because if I own a current slice, it just gets cut off and given to someone else. So it means if they issue shares, my ownership portion of the company decreases. So it's good to see they haven't done that. And then this top shareholders section, what I'll look for here is basically if there's been any major changes in people's portfolios that are worth noting. In this case, the top 25 shareholders own about just under half of the company, which is pretty not conservative. It's pretty consolidated. And so I can see here that Jeff's the biggest shareholder, and then the next are the likes of these institutions, the Vanguard Group, BlackRock, T. Rowe Price. And I just want to have a look at if there's any large changes in their positions, both positive or negative. If any of them have significantly increased their holdings, then that's a positive sign. If any of them have significantly decreased their holdings, there's something to look into as to why. So as we can see here, there's no huge changes over the course of the last year, I believe it is. So 2 reporting dates. So there's nothing really that concerns me. And then there's just some more company info at the bottom of this report. But so that's what I start off with. This is the company report. This is the company report, and what I do here is what I've learned is that Amazon has a great financial health in terms of it's very conservatively taking on debt, but it can afford all of it. It's got an incredible past track record, so that helps me make a bit of prediction about the future, and it has very high expectations for the future, so it's expected to really experience strong earnings growth. The valuation seems pretty appealing, and it's what I'll look into further and basically run my own numbers on it and see what I think. But that was a good sign so far. And then as for the dividend, they're not paying out a dividend; they're reinvesting everything, so that's fine by me. The next steps of what I do in my process is, like I mentioned, I'll go through those recent updates and the news and read through all those articles, understanding that they're people's opinions. But it's building a narrative and a thesis around the stock, understanding the positives and the negatives and what people are bullish and bearish on, and just getting more of an understanding of the underlying business. And I'll also look at those developments, like the strategy and management ones that happened over the last 3 years or so. And I'll try and look for ones that are any sort of near any big share price movements that have occurred. So that's just what I'll do next, and I'll also look into that the cash flow statement, and want to look into why there was a dip recently. But so that's the first part of what I do with the stock. So I've now got a great understanding already, really good insight into the stock. and I am still interested in looking into it. So I'm going to add it to my watch list because basically I want to keep an eye on it. And now Simply Wall Street will like send me updates about it. So if there's any important updates, I'm going to get notified since it's in my watch list now. So it'll tell me like, I think the company's earnings are announced tomorrow actually. So that'll give me an update on them. And yeah, I'll basically just be notified of anything important from Simply Wall Street. So yeah, just wanted to do this video. Sorry, it's probably gone a bit long, but I just wanted to show you how I research a stock and share some of the insights that I can find in the company report and how it forms a part of my whole investing process and like what I do next. So yeah, hope you got some value out of watching that. Thanks so much. See you later.